The information provided in this program is of a general nature and is not intended to be personalized financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. Nvidia's value has hit $1 trillion. Is it too late to buy in, or is there still upside to come?
Well, we're still pretty early in the proliferation of large language models and AI into a whole lot of different areas and applications.
And index investing is popular, but what does the evidence say about passive returns versus actively picking winners?
We saw that 51% of large cap funds underperformed the benchmark.
It's Friday, the 2nd of June, and you're watching Markets with Madison. If you bought Nvidia shares at its most recent low in October last year, you would have tripled your money in 8 months. Its surge in value has come as more investors learn about its links to artificial intelligence and just how dominant of a player it is in that space. But some think it's hit a peak and is due to drop, despite its growth opportunities in AI. Tech companies are going all in on AI, but the infrastructure it relies on is owned by Nvidia. It invented graphics processing units, GPUs, in 1999. Thousands of them are now used as the processing power behind machine learning language models like ChatGPT. Nvidia is technically classified as a semiconductor chip company. Its chips have historically been used to power 3D graphics and consoles in gaming. But its CEO, Jensen Huang, called the use case for AI early and says it's now at an inflection point. Nvidia's sales for GPUs, which is wound into its data center revenue, hit a record $4.3 billion in the first quarter of this year, compared to gaming revenue, which fell almost 40%. It's expecting total revenue for this current quarter to be $11 billion. Investors have piled into the stock this year. It's up 160% and tipped over $400 this week. Its price to earnings ratio is over 200 times, suggesting it's overvalued. But many analysts are sticking with it because they believe there's more upside to come, including Jarden's Ben Stewart. Ben, thanks so much for your time. Good to see you.
Cool, you too.
Are you buy, hold, or sell on Nvidia?
Yeah, we bought originally September 2022, and so we've held on and had one trim since then. It's something we're kind of actively looking at given the valuation. So it's trading on a next 12 months PE of about 46, so quite high compared to its history and high compared to the rest of the NASDAQ, which sits at a forward P of about 27.
You're still in for now though, so what do you think the upside argument is on Nvidia if there is one?
Well, we're still pretty early in the proliferation of large language models and AI into a whole lot of different areas and applications. And so Nvidia is really a key beneficiary of that. They've got three big advantages there. So number one is their semiconductors and their chips. So those are GPUs or graphics processing units. Secondly is their networking. So they've got two products there that are kind of better than the rest in terms of a competitive advantage. So that's their NVLink and their InfiniBand. And then thirdly, they've got their software stack, which is it's known as CUDA, kind of like Barracuda. So Jensen Huang actually has a tattoo of a Barracuda on his arm.
The fact you know that, like you know the stock so well, don't you?
Yeah, so that software stack that they've got is really impressive, and it's got a lot of really strong network effects as well. So people kind of learn how to use it in an academic setting and then go and apply it in an industry setting.
So what do you think that means for its future growth opportunity?
So they are pricing it that way, and a big part of that as well is the margin story. So the margin on these high-end AI chips and server sets, etc., it's a lot higher than the rest of the group. So as the mix shifts to demand from those products, you can see a lot of growth there.
You have taken some profits though. Why did you trim? What was your reasoning there?
Kind of normalizing some of the profits, I guess. We'd gotten into the stock early. It had been a massive beneficiary from a lot of the AI application, more so than we anticipated, to be completely honest. And so we did trim, thankfully.
There's been enormous hype around Nvidia in just the past month. We only spoke about it a month ago, and here we are talking about it already again. Who do you think has actually been buying in? Has this hype flowed through to the average retail investor yet?
I think it has flowed through a bit to the average retail investor. I know a lot of hedge funds as well have been buying. So lots of hedge funds were kind of underweight some of the big tech names, and then started to kind of move into the stock. There's been some institutional buying, so it's pretty broad-based.
Obviously, Nvidia is just one stock that's benefiting from this AI boom. If somebody wasn't going to invest in Nvidia because they thought it was at or near the peak, what else could they buy?
There's a number of other stocks. So across software and semiconductors, one of the major ones that a lot of people are investing in is Microsoft. So Microsoft partnered up with OpenAI and own quite a large stake in OpenAI.
What about other stocks that are closely linked to Nvidia's success, like TSMC, for example? What about that?
Yeah, TSMC is strongly linked to Nvidia's success. They're the core producer of GPUs for Nvidia. And so, there are some risks there as well, geopolitically, given its proximity to China and across the Taiwan Strait. So, if there were, in a worst case scenario, to be an invasion of Taiwan, Nvidia would see a bit of a supply crunch in the short to medium term on its GPU chips.
That's clearly quite a big risk for Nvidia. What are the other potential risks for Nvidia?
The other potential risks are, with any new technology, there's always iterations of it and changes to the way that it operates. And so if some of the training and inference becomes far more efficient to do on a smaller scale, or if regulations kind of impede or slow down some of the growth, those are some risks around the stock as well.
I've seen Tesla get a bit of a bump this week too, and there's been some commentary around Tesla possibly being the next biggest, best AI company. What do you think about that?
I think there's a possibility for Tesla to benefit from AI. In the driverless kind of arena, it's quite a big addressable market that they could potentially capture. There is a lot of regulatory and safety concerns around automated driving systems, and I still think that it's a pretty early market to be betting on.
Is Nvidia worth $1 trillion, Ben?
It was worth $1 trillion earlier this week. It's since faded that rally. I think you have to kind of look out and see longer term, like what are the earnings going to look like. It seems like there's recently been a lot of upgrades to earnings come through from analysts on the street. Nvidia's also got a pretty strong history of beating the street and also beating its own guidance. So since 2013, they've only missed 3 times. So that's a pretty good track record in terms of their guidance and where they kind of come in with their numbers.
If you sell, can you let me know when?
Yeah, we'll see.
Let's talk about index investing. The S&P 500 has made an average annual return of around 9% for the past 150 years. Obviously, that's not adjusted for inflation, but bottom line, investing in an index is typically pretty fruitful. Data from S&P Dow Jones Indices says long-term, it pays off more than active management. Its Director of Index Investment Strategy, Anu Ganti, was over from New York this week, and I asked her to explain the evidence. Anu, thank you so much for your time.
Thank you so much. It's so nice to be here.
You're obviously pro-passive index investment. Does the evidence stack up in your favour?
Well, I think it's a good question, and what I would point to is our SPIVA scorecards, and SPIVA stands for S&P Indices versus Active. And to give you a little background, we've been producing this for more than 20 years in the US. That's how it started. Then it expanded to Europe and then to Asia, Australia, for example. So we've been doing it all around the world. And the evidence really shows that it's very difficult to beat the benchmark over the long term. So in the short term, you may see some noise, different statistics. For example, in the US last year in 2022, we saw that 51% of large cap funds underperformed the benchmark. And it was actually the best year since 2009 and the 4th best year in our database. But if you look over the long term, that's where things start to get more difficult. And the statistics are very consistent around the world, which is fascinating.
When you say long term, how many years are you talking about in terms of passive always beating the benchmark?
Yeah, so it really depends on the category. It depends on what region that we're looking at. For example, in the US, we go out to 20 years. Other regions are a little bit shorter, but very consistent trends over the long term. And we do, 1-year horizon, 3-year horizon, 5-year, and we take it out the spectrum. And what I'd like to point to is we show various different metrics, right? We show equal weighted returns, asset weighted returns. We show the percentage of funds that have underperformed the benchmark appropriate to the category. And very importantly, we account for survivorship bias. So we look at the entire opportunity set at the beginning of the period, and then we also show funds that have merged or liquidated. So it's very interesting to see all these statistics, and every year we just get more data at our fingertips.
You say it's pretty consistent everywhere in the world, passive outperforming active long term, but is there any place in the world where active is doing slightly better than other active fund managers?
Yeah, no, it's a great question, and I'll tell you, I'll go back to the US, for example, because if you had a crystal ball, right, and you could think about what are all the conditions that I would want to see as an active manager, we got all of those conditions in 2022. And to give you an example, we got higher volatility. You got a down market, because perhaps in down markets, active managers can go to cash. We got higher dispersion or cross-sectional volatility, so greater opportunity to add value from stock selection skill. We also got the underperformance of the mega caps, which is interesting because it may be harder to overweight these large mega cap names. So when they're doing poorly, that might have provided a tailwind. So all the cards are stacked up. And what I always like to say is, we report on periods when active is done relatively better. We also report on periods when active is done relatively worse. I'd also like to point you to our persistence scorecard. It's a sister scorecard to our SPIVA scorecard, where we look at managers and we slice them by quartile and by half, and we see what percentage. So if you were a top quartile manager or a top half manager, were you able to stay in the top quartile or the top half over the subsequent, say, 3-year period or 5-year periods? We slice and dice it various ways. And what we also notice is it's difficult, even if you have outperformance, to maintain that consistent outperformance. Persistence is very difficult as well.
I guess for something like index investing, though, is, as you mentioned, it's pretty hard to lose long term. But can you win? Because you're not actively looking at opportunities, are you? You're effectively putting money in a benchmark and betting on the fact that it will increase long term, which, of course it would, right?
I think diversification is so important. And, we study this all the time. And there's a concept that we look at called skewness. And what it means is that outperformance in the market tends to be driven by a few stocks. We've seen it all around the world. So if you're an active manager and you're holding fewer stocks, you're more concentrated, you may not have those winners, and you may not know what those winners are going to be in the future, which really makes the case for holding more stocks, having more diversification, and just having luck on your side. We see it in New Zealand too, by the way. So New Zealand is no exception. We see it here at home as well. So that just makes the case for the benefits of indexing. I'd also like to point out is cost savings. So we've done some studies in the US to estimate the cost savings that index investors have achieved. And what we did is we looked at the difference between average active versus passive equity mutual fund ratios, and we multiplied that by our indexed assets, S&P 500, 400, 600. We looked at it over 26 years, and the number comes out to $403 billion estimated in savings. So that's a big number, but it actually the actual number would be even bigger if you included all of our indices in the world. So a very big benefit there.
As index investing becomes more popular, though, do you think it's become cheap enough? Is it accessible enough, given how easy it should be?
Yeah, I think, I like to call them generations. We like to think of them as generations. You started out, if you look back over the past 30, 40, 50 years, we started with market cap weighted indices, like the S&P 500. And then you got sector indices. Then you got industry indices. Then you got smart beta or factor investing, right? And then the latest evolution has been in, ESG and thematic investing. And we like to use a word called indicize. So what that means is putting into passive form strategies, let's say 50, 60 years ago, I didn't have. I'd have to go to an active manager to get that exposure. And now you have the passive form available. So it's been, I would say, in modern financial history, one of the most significant achievements that we've seen.
So you don't think that we possibly hit peak passive? You still think there's opportunities for more indices, more ETFs?
I think it's a common question that we get, and I think it'll be interesting to look over the next 20 years, the next 30 years, to see if we get some sort of an equilibrium, a long-term equilibrium between active versus passive. And of course, there are active managers out there who have the skill, but I think what our SPIVA scorecards show is they're in the minority, and that it's just very tough.
Your favorite index, Anu?
Favorite, I can't say I have a favorite. We love all our children equally, but I think, like I say, indecise is the word I would refer to, because it just continues to spread, and we see the benefits.
Thank you so much for your time. Good to chat.
Thank you so much.
I want to hear from you this week. Index or active, which strategy do you prefer? And are you in or out of Nvidia? I actually had a guy called Jim comment on my TikTok this week, and he told me that he has a $13 million long short on the stock. So if you can beat that, please let me know and how it goes for you. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below, and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.